it's wise to be a little conservative. Never, never, never get out of the market.
Jack Bogle, the legendary founder of Vanguard and pioneer of index funds, gave us powerful insights into what might unfold in an overvalued market. As we face 2024, could we be looking at a significant market correction or even a crash?
Tons to talk about. Let's just start maybe with a kind of a synopsis of the last 10 years. What are the lessons we've learned, and where are we right now in the post-financial crisis world?
Well, this is a great time to ask that question because it seems pretty clear to those of us who are expert, who may know nothing, never forget that, that we're going into an era of much lower returns than we've been accustomed to in the past. And how that will play out, nobody knows. I would be in the camp of saying the market is significantly, not grossly, but significantly overvalued. And assuming that's correct, there are only two things that can happen. You can have a long period of very low returns, or a great big drop in the market, 30%, 40%, even 50%, and then get back to the good returns of the good old days. That's a hard way to do it. But it seems almost inevitable that returns will be lower somewhat than this 35 years or so that we've had the greatest bull market in recorded history, with the S&P 500 growing at 12% a year, which means, mathematically speaking, simply enough, that if you started with the S&P 500 35, 40 years ago, you now have $60 for every dollar you started with. And so it's not genius, it's the market.
For decades, Bogle has been a voice of reason, encouraging long-term, data-driven investing. He always cautioned investors to be wary of speculative markets, where prices climb too high and risk outpaces the fundamentals. Bogle warned that as markets grow overheated, they become overvalued, meaning the prices of stocks no longer reflect their true earnings or potential. This is the situation we may be facing today in 2024. But what does this really mean for investors like you? Over the past decade, the stock market has delivered extraordinary returns, largely fueled by a combination of corporate earnings growth and speculative bubbles. But as Bogle often said, trees don't grow to the sky. The massive gains we've seen in the last 10 years are unlikely to continue indefinitely, and this bull market cannot last forever. Enjoying the video? Don't forget to hit that subscribe button. Like the video and turn on notifications so you never miss out on more insights and tips that can help you become a smarter investor. Bogle's investment philosophy is built on a clear understanding of how markets function. He divided market returns into two key components: investment return and speculative return. Bogle argued that these two elements provide a rational and data-driven way to predict long-term market behavior. Investment return is based on real business performance, how much a company earns, and what dividends it pays out. Speculative return, on the other hand, reflects investor sentiment and the price people are willing to pay for a stock relative to its earnings. Bogle pointed out that while speculative return can inflate stock prices in the short term, it is unsustainable in the long run. A stock price may rise because investors are willing to pay more for every dollar of earnings. But eventually, reality catches up. This is why speculative bubbles often end in sharp corrections. So, what does the future hold for 2024? According to Bogle's method of analysis, we are likely heading into a period of much lower market returns, potentially around 4% annually over the next decade.
I'll just take a moment maybe to talk about my methodology. And this methodology is so good and so popular that it has never been used by anybody but me. But for 25 years, I've been using the same methodology, so it's all what actually happened after prediction. And I divide the market, the market return, into its two sources. One is investment return, one is speculative return. What is investment return? Today's dividend yield plus whatever earnings growth we get in the future. You know, it's averaged about 5%. Could get to 6%, 6 or 7%. It can't really be much higher than that. And unless you get a depression, it's not going to be much lower than 2. So there's not a lot of room to differ there. But I'm using right now for the next, the long-term average is about 5% earnings growth. So we take today's 2% dividend yield, and my guesstimate, gives us 6% investment return.
Bogle's projections were always cautious. He emphasized that market valuations are high right now, which means that future returns will likely be lower. He calculated that with current dividend yields at around 2% and expected earnings growth of 4%, we can reasonably expect about a 6% return from the investment side. But here's the catch. Speculative return driven by investors pushing up stock prices has already run its course. As Bogle explained, P/E ratios aren't likely to double again as they did in previous decades. This means speculative return may even subtract from future gains, leading to overall market returns closer to 4%.
The crowd, I was always taught the crowd is always wrong. So we will see, but I think it's, for an investor who's thinking ahead, it's wise to be a little conservative. Never, never, never get out of the market.
Bogle's most crucial advice to investors: stay the course. Even when returns are low or markets are volatile, exiting the market can be a costly mistake. Long-term investors have always been rewarded for their patience, even during periods of low returns or corrections. By remaining in the market, you benefit from compounding and recovering when markets eventually bounce back. This is the essence of Bogle's wisdom. Keep your costs low, invest in broad index funds, and hold on for the long term. As we look toward the future, Jack Bogle's advice remains as relevant as ever. In an era of overvaluation, speculative bubbles, and uncertainty, his timeless principles guide us to a safer path.
So one of the lessons is, I think, or one of the messages, perhaps more importantly, is the trees don't grow to the sky. And I'm really quite confident about that. But confidence in this business is a dime a dozen.
Bogle's confidence was never in the market's ability to climb forever, but in the principles that help investors succeed over the long run. Stick to the basics: low-cost index funds, steady long-term holding, and a focus on what truly drives market returns business performance, not speculation. Jack Bogle revolutionized investing with one simple idea: common sense. As we face the unknowns of 2024, let his legacy guide you. Stay invested, stay patient, and always trust in the power of the long term.